Good afternoon, everyone. Welcome to our webinar, Economic Relief Through the Families First and CARES Act. We're live from lovely Florence, South Carolina. And today we're going to be talking to you about the tax credit and some other economic relief programs that have come out recently through Families First in the CARES Act in response to the COVID-19 epidemic. So today I have with me I have Perry with me. I'll introduce myself first. My name is Kirsten Nemec. I'm the Chief Service and Product Officer with Synergy Partners. I've been in the tax credit business for almost 30 years now. I was a tax partner with KPMG in New York City, as well as a Senior Vice President with GE and ADP. Perry, would you like to introduce yourself?
Sure. Good afternoon, everybody. Thanks for joining us today. I'm Perry McLennan. I'm a labor and employment lawyer at Haynesworth Sinclair Boyd Law Firm. I also do some work on economic development incentives and general business matters as well, and have been spending a fair amount of my time in the last couple of weeks studying new federal legislation through the CARES Act and the Families First Coronavirus Response Act. I hope everybody is hanging in there. I know it's tough times and a lot of difficult decisions are being made. Hopefully this webinar today is going to be mostly good news because we're talking about credits and reimbursements that you can receive or loans that you can receive to offset some of the financial difficulties that I know that many of you are facing. So with that, we'll jump right into it. I'll tell you that we've got 45 minutes allotted today. I'm going to probably spend about 15 minutes mostly going over the Families First Coronavirus Response Act, and then I'm going to turn it over to Kirsten, who's going to spend about 15 minutes on her side. We plan to reserve about 15 minutes for questions. We know that many of you have questions and get a lot of value out of this. If you'll notice, for those of you who are not familiar with Zoom, there's a Q&A box on your screen. If you can go ahead and type in your questions using that Q&A box, that's what Kirsten and I will use to answer questions. We may type some responses in there throughout the presentation, or we may verbally address some of the questions at the end of the presentation, but please use that feature. I will tell you that I'll go ahead and make the disclaimer as far as the Q&A goes that these laws are brand new. Those of us who have been studying it are still learning about it. There's still a fair amount of uncertainty and vagueness in how some of the mechanics of the programs work. We are still waiting on additional guidance through regulations and more informal guidance from the administrative agencies that are running this. And so keep that in mind with very specific complex questions. We will do our best to answer those, do the best that we can. With that being said, I'll jump right into it. You can see here on the first slide that we have, this is just a little bit of an overview of what we're going to talk about today. I think one of the important things just right off the bat is that in sort of strategic planning for your organization, you've got to know what your options are. And we've outlined here what the primary forms of relief under the new legislation are. I will go ahead and mention that not on this chart is the Economic Injury Disaster Loan Program through the SBA. That is an additional form of relief. That's more of a traditional loan and does not have a forgiveness portion or any kind of reimbursement credit portion. So that's why we're not drilling down into that program today. But generally speaking, those are loans to businesses that are made directly by the Small Business Administration. So if you're interested in one of those loans, you've got to apply to that directly through the SBA, not one of the private SBA lenders. As I mentioned, those loans are on very favorable terms, so they may be a good idea, but there's no forgiveness component to it like there is with the Paycheck Protection Loan Program, which we'll discuss. We've had a lot of questions about, can you apply for an economic injury disaster loan and a loan under the Paycheck Protection Program? And the answer to that is yes. And it may be a good option for some businesses to apply for both. You cannot use the loan proceeds for the same purpose, but the loan, the eligible expenditures under the EIDL program are broader. You can use those for working capital, generally speaking, and under the Paycheck Protection Program, at least 75% of the funds have to be used for payroll. A couple of other things here on this chart. You'll see the number of employees. 500 is kind of the magic number with most of these programs. That's how these programs are defining what a small business is. We've gotten, I at least on my side, have gotten a lot of questions about, how do you count employees? Do you include this person? Do you include that person? What date do you look at for determining? It's a little bit different under the programs. I would say if you've got specific questions about counting employees and how to do that, I'm sure, either HSB or Synergy would be happy to help you through that. But 500 is kind of the magic number here for small and mid-sized businesses, which is what this legislation is intended to assist with. The Families First Coronavirus Response Act is available to all, or is required to be followed by all businesses with under 500. The Paycheck Protection Loan Program is the same, although they have slight differences. Under the Paycheck Protection Loan Program, there are exceptions to that 500 requirement according to SBA standards. If you are otherwise an eligible small business, as the SBA defines that, and you have to look at your industry classification code to find that out, then you still could be eligible. But this little chart just shows you kind of whether or not you're eligible for each program based on what you have. And you'll see employee retention credit and payroll protection program. Those, are kind of either or type programs, which we'll discuss. All right, Keely. All right, there we go. All right, I'm going to give a quick overview of the Families First Coronavirus Response Act. The purpose of this webinar today is not really to drill down on how you go about deciding whether employees are eligible for leave. We're really going to focus more on the the reimbursable credit side. But I do think it's important to understand a couple of things about the program. First, it was passed on March 18th and effective April 2nd. The April 2nd date is important because it's not retroactive, meaning that if you had employees that were out on leave and you've made payments to those employees for dates prior to April 2nd, that's great, but you're not going to be eligible to be reimbursed by the government for those payments. So that's an important date to keep in mind. And it lasts through the end of the year, into the calendar year, December 31st. The purpose of the program is to provide relief to workers who can't get to work because of certain COVID-19 reasons. They've got childcare issues, they're under an isolation order, etc. The program is not meant to benefit those businesses that have had to close or have had to lay off workers. Those folks are not eligible. These are just for your employees that are still working, that are eligible under this program. As I mentioned, it applies to employers with less than 500 employees. There is a limited exception for those small businesses that have under 50. And the importance of this, and what I want to highlight, is that if you fall within that category, if you've got under 50, you've got a decision to make. You can try to claim the exemption, which if you meet the criteria, which is basically that making these payments would jeopardize the financial stability of your organization. If you claim the exemption, then you don't have to make these payments. However, if you're under 50 and you still choose, you don't claim the exemption, you still choose to pay out these amounts, you can get reimbursed. So I think there is going to be a decision there for those under 50. And the key component of this program for the organizations is that there are refundable tax credits available, which we'll discuss here in a second. So this is a couple more points on just basics of how it works. Sick leave, 80 hours of leave at full rate or 2/3 of the employee's regular rate, depending on the reason that they're out. And I'm just hitting these really quickly. There are quite a few nuances to some of these, but just want to give you an overview. Emergency FMLA is 12 weeks of job protected leave, paid at 2/3 of an employee's regular rate. The only qualifying reason under that program is can't get to work because of a child care situation. I mentioned that it applies to leave taken between April 1st and December 31st, 2020. And I'm realizing now that I'm reading this slide that I misstated earlier and said April 2nd. That's what everyone was anticipating when the law was going to take effect, but it actually took effect April 1st. I apologize for saying that earlier. So as of April 1st, it went into effect. And if employees were out as of April 1, you can include April 1 in these payments and still receive reimbursement. There are maximum amounts of leave that employees are entitled to, both per employee and per day, and they differ depending on the reason that you are taking leave. Those are very important to keep in mind and make sure that you're not paying over that, because you're only going to be eligible for your reimbursement from the IRS for up to the caps in the statute. So that'll be important to keep in mind. And two other points, company provided additional leave is not eligible for reimbursement. So if the organization decides, you know what, this person is only entitled to 2/3 pay, but we're just going to keep paying their regular rate because that's something that we want to do for our employees, or we provide a generous PTO policy or whatever, none of those payments are eligible for reimbursement. Only those payments that you're required to make under the Act are eligible for reimbursement. So, you know, that's an important point, that before you start paying out these amounts to workers that request them, make sure your ducks are in a row as to whether the employee is actually eligible, whether you're an eligible employer, and what exactly it is that you can pay to make sure that you are going to be reimbursed in full for whatever you pay out. Okay. So let's talk a little bit about the reimbursement. The idea is that this is not supposed to be, Congress's idea was that this is not supposed to be an employer cost. That this is supposed to be on the taxpayers and the federal government. That it would sort of defeat the purpose of the program if they're asking, you know, businesses to take on this cost. And so if you're doing it properly, you can receive dollar for dollar 100% reimbursement for everything paid out. And that would include health insurance costs that the employer bears during that time that the employee is out on leave. One of the immediate criticisms of this bill was that from small businesses was, okay, this program is great, but the way that it operates, businesses are going to have to bear the upfront cost of making these payments, and then we're going to get reimbursed at a later date. And so, you know, our financial stress is happening right now. We need immediate relief. So the IRS has released some guidance which essentially allows companies to take immediate advantage of this by reducing the required deposits of payroll taxes. And I'll explain a little bit about the mechanics of how this works. So every quarter, your business, and I'll go ahead and make the disclaimer that I'm not an accountant, but every quarter your business files the Form 941 with the IRS, which is the quarterly deposit of employee withholdings, as well as the company's share of the taxes, the FICA taxes. And the scheme that Congress and IRS has set up is they're going to allow companies to retain whatever amounts that they paid out under this new law. Instead of depositing that quarterly with the IRS, you're going to be able to retain that amount. So it helps if I use an example. So if you paid out $5,000 in leave payments pursuant to this law, and you would otherwise deposit $8,000 with the IRS for your quarterly payroll tax, you are allowed to withhold that $5,000 and only deposit $3,000. There's also a mechanism in there that if the payroll tax is less than what you paid out, so if you paid out $10,000 and were only required to deposit $8,000, you can go ahead and deposit the $8,000, or go ahead and withhold the entire amount, and file Form 7200 and ask the IRS for an expedited payment of that extra $2,000, so that you're trued up as soon as possible. The IRS has stated that they expect processing on this to be quick, that they're hoping that in 2 weeks or less of filing the Form 7200, that you can get payment. And I've included a link to the IRS guidance on that point below. And that's essentially how the program works. The one last point before I kick it over to Kirsten is that, record keeping, as always, is going to be paramount here. You've got to, document employee requests for leave, decisions that you make with respect to that, how much was paid out on what dates, and all of that kind of stuff, in case there's any questions when you go to seek reimbursement from the IRS. Kirsten, I'll kick it over to you.
All right, thank you, Perry. So the program Perry just spoke about is quite significant. It's the estimated spend on that by the federal government is $105 billion. And when you think about that, that's slated from now through the end of the year. So it's a significant impact that's happening quite quickly. And then a lot of the other credits that we're going to be talking about today, they're all claimed on the same Form 7200. So this is what we wanted to show you, is how this all kind of interrelates with each other, because it can be so confusing with the two different acts and all the different rules. So the two things that we're going to talk about next are the employee retention credit, which is valued at $55 billion, and then the Paycheck Protection Program, which is the forgivable loan program. And these two are paired together in a sense that you can only take one or the other. So it's really putting employers kind of in a tough spot to figure out things rather quickly. So you're going to have employers that are eligible for the loan, for the Paycheck Protection Program, the forgivable loan program, and the retention credit, that they have to decide fairly quickly which way they're going to go. So we're going to go through both of those programs right now, and hopefully we can clarify some issues for you. So the employee retention credit is a mechanism that came out through the CARES Act, and it was designed to help employers keep their folks on payroll. So it's a refundable payroll tax credit up to 50% of the wages paid during the epidemic. So again, it's just a way to get money into employers' hands. And so 50% of the wages, The maximum credit per employee that an employer can take is $5,000 or $10,000 in wages. To be eligible for the credit, a business must show that they were fully or partially suspended operations due to any government mandated shutdowns, which is pretty much the entire country right now has had mandated shutdowns. And if they haven't, then a company can also become eligible if they've experienced a 50% decline in sales. Now, the wages can be taken into consideration for starting on March 12th for each quarter that they show the business was impacted by a mandated government shutdown or they had a loss in gross receipts. And so that's a starting trigger, and it'll keep running each quarter until there's either not a shutdown or the company's gross receipts are 80% of what they were compared to the prior quarter. So most businesses, how we look at it right now with the mandated shutdown, should probably easily qualify for this credit in first quarter and second quarter, and then it's just going to be a matter of third quarter, what's happening to their business. Now, what's happening with this credit right now, where the big difference comes into play on the value to an employer, is based on the number of employees that you have. So if you're considered, small employer, you have 100 or less employees, then this credit can be applied to 50% of all wages paid during the designated time frame. So it can add up very, very quickly. Now, if you're over 100, then it kind of tightens up the rules a bit, where it says the credit can only be applied to wages for not providing services. So that's going to have to be, PTO time, sick leave, things like that. It can also be if you've furloughed employees. It can include any severance payments. It includes healthcare benefit, the employer share of any benefits costs. And we're also working right now on a model that we can use and apply to various businesses on how do you measure productivity, because as we all know, a lot of us are having to work from home, just productivity is different, but but people are still getting paid the same wages, but not providing the same level of service. So we're trying to come up with some mechanism that appropriately measures that, and then that factor can be applied to the wages as well. And really the thing to look at here, and again, this causes a bit of confusion among everybody, is all these, the headcount numbers, because I do think it's spelled out differently in the CARES Act than the Families First Act. And in the CARES Act, when you're looking at headcount, it's referring to full-time employees, so like 100 full-time employees as defined by the Affordable Care Act. So basically anybody who's working 30 hours or more on average and benefit eligible under the Affordable Care Act. So you could be an employer that has 50 full-time employees and 100 part-time employees and still qualify for this credit. And again, this credit is taken against payroll taxes. It's filed on the same form 7200 that Perry was referring to. All three of these credits are on that form. It's the leave, any leave payments, any sick payments, and then the employee retention credit. And whatever is left from the taxes you would normally owe, the employer taxes you would normally owe, it's refunded to you. And this applies to all business types and nonprofits. That's kind of a new thing that we're seeing with these credits. Usually when you see the business credits, it's not applicable to nonprofits because they don't have taxes, but because this is applied against payroll taxes, this applies to pretty much any business or nonprofit out there unless you're a government-related employee. Next slide. So now, companies right now have to choose between, if they're eligible for both the Paycheck Protection Program and the Employee Retention Credit, they have to choose between these two. And so with the Paycheck Protection Program, the forgivable loan, this is eligible for employers with less than 500 employees total unless you're in the restaurant or hospitality NAICS code, and then then it can be measured by location. And it's a forgivable loan that's based on 2.5 months of your average payroll, your historic payroll, not to exceed $10 million. So if you had $10,000 a month historic average payroll, then you would be eligible for a loan amount of $25,000. And then you're given an 8-week performance period. Once you receive the loan proceeds, you're given an 8-week performance period to spend this money on payroll. And there's rules around like how much you can't go out and give everybody, double and triple everybody's compensation. So there's certain rules that have to be met. But this loan was intended to pay payroll costs. So 75% of it has to be spent on payroll. A minimum of 75%, and the other 25% can be used for things like interest, mortgages, rent, things like that if they were in place prior to the COVID epidemic. So that's what the proceeds can be spent on. And then there's going to be an exercise on the back end of this after the 8-week period where borrowers are going to have to go through and show what they spent the money on, as well as what their headcount looks like, and can ask for loan forgiveness. And forgiveness is based on how your headcount compared prior to COVID. If you've maintained headcount and the pay, you have until June 30th to get your headcount back up to where it was, and people's pay back up to where it was. And there's some requirements, and there's a little bit of wiggle room, but the intent is for people to bring back their employees and keep them on the payroll. And so if that's accomplished, then the loan can be forgiven. Now, if it's not, then it converts to a 24-month 1% rate. So these loans went live. They started taking applications last Friday. It's a $349 billion program. And from what I understand, there was $1 billion being approved every hour. And so these were fast and furious, first come, first serve. They're 100% guaranteed loans, government-backed guaranteed loans. So it's kind of been fast and furious. We expect there might be another round of funding for these because we think the first $349 billion will be allocated by tomorrow, if not the end of the day today, since things are moving so fast. So there might be another round of this, but when you're looking at this and what can be approved and what you can use the proceeds for and what can be forgiven, it's really important that you understand the rules for forgiveness on the back end, because the credit program, there's no what I would call clawbacks. Once you submit and calculate the employee retention credit, that money is yours. On the Paycheck Protection Program, you're going to have to go through a forgiveness process on the back end, and you may or may not have to pay it back. So that's one issue that employers need to look at. So they need to look at, like, did we let go a lot of our people? How do we compare, prior to COVID-19? And are we going to bring those jobs back by June 30th? And if you're not, there's definitely some risk. There's absolutely some risk there. And then you also have to look at, like, how long is it going to take your business to recover, because the employee retention credits can run. You can take those credits depending on how the business's recovery is going. You can take those all the way through December 31st of 2020. You can take it until your business gets back to 80% of what its sales were in the prior year. So if you have, if you've laid off a lot of employees, or your headcount's gone down, or you tend to have lower paid hourly employees, maybe that they're making less than $25,000 a year, when we've modeled it, you can come out ahead on the credits versus the loans. Next slide, Keely. And I know that y'all, this is so darn confusing. And so what we've done to make it a little bit easier is we've had loan versus credit estimator that's out there. We put it on our website where you can put in some basic parameters about your business, and it'll actually run scenarios for you on what the loan would look like versus the tax credit. So at least it'll help you on the front end, because people are having to make decisions really, really quick on this. Right, next. And so when it comes to claiming the credits, so like we were talking about, all three credits can be claimed for the refund on Form 7200, the advanced payment of employer credits due to COVID-19. So they're all on the same form. The form, when you read it, it keeps referring to the 941, your quarterly employment returns that are filed. So a lot of people are assuming that the 7200 needs to be filed quarterly. It can be actually filed more often than that, because the intent of this program was to get proceeds into businesses' hands as quickly as possible. It just has to be, every time a 7200 is filed during the same quarter, it has to be cumulative. It has to be done on a cumulative basis, so it can track like how much credit's being generated and how much taxes are owed each quarter. The other thing to note on this is, with these credits and the refunds, there's several business, what we call general employment related business credits out there. The employee retention credit, the work opportunity tax credit, disaster credits, the live and sick pay credits that Perry talked about, and the credits cannot be taken against the same wages. Because they don't want to have, they would call it double, triple, or quadruple dipping, where you're taking credits on the same dollar paid to the same person. So there's an exercise that has to be gone through on the back end to make sure that there's not any overlap in the credits and that the credits are being maximized. And what we're going to be doing is just working with clients to make sure that the credit reports are prepared accurately, credits are calculated, and everything's reconciled for the various credits, and given to people monthly or more often to file on the 7200. All right, next. And like Perry said, once the 7200's been filed, the IRS should turn around payments fairly quickly. Within 2 weeks is what we're being told. So then it's really up to a company on how frequent, how big of a refund do they expect to get, and how frequent do they want to file this form. So we're getting a lot of questions on, well, what, sounds very complicated, and what kind of data is required to document and process these credits, because things are moving very fast paced to try to get the economy kick-started again. But we all know on the back end there will be checks and balances at some point. So we're trying to get our arms around that on the front end on what data and what documents need to be there in order to support any questions or reviews on the back end. So for the employee retention credit, here's just some examples of what might be needed is just demonstration of business impact due to mandated closures. And this could be fairly simple. We're already starting a database of closures by locale. So we have that to substantiate the closures. And then it's just a matter of looking at the industry and how the business was impacted. Or if the trigger for the credit is going to be a decline in sales, pulling the sales data and having that handy. All the three credits that we talked about today, they are all calculated based on payroll data and healthcare cost data. So it's pulling the payroll files together every pay period and qualifying the people and the wages that are eligible for the credit, and then applying the credit rules against those wages. Things like monthly P&Ls are going to need to be gathered. And again, you have to do a quarter by quarter check on how your business's sales and income were impacted by the coronavirus to see if you're eligible to go into the next quarter claiming the credits. And then leave and sick hours related to COVID-19, the stuff that Perry talked about earlier on all of the leave and sick pay and the hours, and making sure that that's tracked appropriately and claimed on the 7200 as well. So that's high level of how the process works and how the credits work. And I would say with that, do we have any questions? I know, Perry, the questions have been racking up as I've been going.
Yeah, so I've been trying to answer questions I could easily type in while you were presenting. And we still have a few questions in the box. I might try to operate as moderator here, and try to see if we can't address a couple of the a couple of questions. I know we've had it looks like two separate questions about what happens if you don't get your loan proceeds under the PPP until, let's say June, for instance. Given the current funding situation, I'm not sure if that's going to be a reality. Unless they appropriate more money for this. I think everybody is probably going to be receiving loan funds prior to then. But do you know, Kirsten, with the 8-week period, let's say you got your money June 1st, with the 8-week period presumably, extend out into, August or wherever?
I would think it would. And I know the intent was once a business has been approved for the PPP program, they're given a loan number right away, and we're being told the proceeds will be put into the bank accounts of the borrower fairly quickly within a matter of days. So we expect this first round, most companies to have their money fairly soon for that 8-week period to start. Now, there's already discussions to add more funding to the program, so there'll be another round. And so I would think, yeah, the 8 weeks would just start after the company gets the proceeds. We also know that Congress is in talks about other stimulus legislation that could be addressed in another 30 to 45 days. It may include other tax programs and spending programs. So is it likely that deadlines will be extended? Absolutely. I would sit there and say at this point in time, anything is likely, and that the country bouncing back sooner rather than later. I don't know how realistic that is. So I would think it would be extended. And if for some reason you're someone who got your loan on June 1st, they're still going to give you the 8 weeks performance period to do that. So the most important thing when you're getting these loans is just to understand the rules on your loan for forgiveness, track how you're spending the money, and track how you're going to show it on the back end so it's not a big surprise. And if you're not sure, just make sure you're conservative and you reserve that you might have to pay some of that back or be ready for it to turn into a longer term loan, which a 1% to your loan is still a pretty darn good deal, but just be prepared.
Yeah. And somebody was nice enough to share something about Treasury Secretary Mnuchin already asking for additional appropriations in the way of $250 billion. I'm not sure if that's going to be specifically for the PPP program or something else, but I would not be surprised if there is more appropriation. Okay, we still got a bunch of questions in 5 minutes. I'll try to, somebody asked if there would be a PDF of the presentation available for download. I think that we are going to send out both the PDF of the presentation and perhaps maybe a recording of the comments as well to all those who attended today to be on the lookout for that. We had a couple questions in regards to, again, sort of the measurement date for counting employees. And I think I answered this for one person on here, but I did see it pop up again. I'm not sure that we exactly have clear guidance on when you determine whether or not you have 500 employees. I think in filling out an application for the PPP loan, I think you're making the certification essentially at that point in time you have less than 500, but there's also been a lot of companies are using their 2019 numbers for purposes of this. So I'm hoping that that's going to be cleared up in some forthcoming guidance. But if you do have specific questions on that, I'd encourage you to consult legal counsel or maybe talk with your banker about it before you apply or accept the funds. Kirsten, we had a couple questions about, one, can we claim PPP and WOTC credits? And then somebody else asks, how can Synergy assist employers who currently receive WOTC remain compliant if also applying for other credits? So I didn't know if you wanted to quickly address that.
Sure. So yes, you can take the PPP and WOTC. The only credit that you can't take with the PPP is the employee retention credit. That's part of the CARES Act. That's the only, pick this, not that program, are those two. And if you're currently utilizing WOTC, what we do is get a copy of your WOTC reports and what wages you're applying the WOTC credit to, and then we compare that to the wages that would be used for any of these other credits and make sure that there's not any overlap.
Okay. All right.
I saw a question on here. If you're a not-for-profit with fewer than 100 employees, and are you eligible for the credit? So as long as there's a a stay-at-home order in place. Yes, you are, as long as you're a not-for-profit that isn't government related, like a chamber of commerce or something that has to do with a government agency.
And I think somebody maybe had asked about, maybe specifically about the Chamber of Commerce, so that's very helpful. I've got one about, and I think this was the second one on this point too, about, again, going back to counting employees, and do you count foreign affiliated companies, if you're a U.S. subsidiary of a foreign parent and all that. I've gotten this question a couple of times from clients, and I think generally speaking, yes. I mean, it is a worldwide employee count, but you sort of have to dig in a little bit to the affiliation rules to sort of figure that out based on your current circumstances. I certainly wouldn't want to discourage anybody from trying to apply for a program that they really could be eligible for. So again, before you make the decision that, hey, I'm just not going to apply for this loan because I think I've got more than 500, I would really encourage you to consult with somebody before making that decision based on your specific, what your corporate structure looks like, how many employees you have, all of that kind of stuff.
Right. In general, I know like under the CARES Act, it's referring to the rules that are used for the WOTC credit, which look to the FEIN and how many the employees that were reported on that FEIN. And then the second test is looking if that FEIN is part of a consolidated return and mixed with other FEINs. But again, like Perry said, if you're close to the 500 or the 100 mark and you have unusual circumstances of, like the question about, foreign corporation, or if some are part-time, or you have relief workers, I think those are the things that need to be kind of a one-off conversation where we can go over head counts and figure out how to document this, because really the intent, it always is going to keep going back to the intent of the program, which was to get funding into smaller companies' hands to keep payroll going. And the intent in looking at it was like, how many full-time workers did you have? And yes, I think there's certainly ways to document that, whether it's looking at historic averages, whether it's looking at your current count. And we just want to make sure, I think the government just wants to make sure there's not any fraud or anybody trying to game the system. But there's been plenty of companies that we've talked to, they're like, shoot, I'm at 103, what can I do? So we're certainly trying to work around those issues the best way we can. I think those are best handled by talking to us or your legal advisor or your tax advisor.
Yeah, I think that's very well said, and that might be we're right at 3:45, and we're scheduled to be 45 minutes, and so I think that might be a appropriate place to wrap it up. I know that we have more questions being asked in the Q&A box. I would really encourage, I'll just echo Kirsten's comments that, these can be pretty big decisions and a lot of dollar value on these decisions. And so I would encourage you, if you've got specific questions, to reach out to one of us after the end of the webinar. We'd be happy to, talk through any specific situations with some of you. And then I had a couple questions again about the webinar and the slides and the recording. We plan to send those out in a follow-up correspondence to everyone who joined us today. With that, thank you everyone for joining today. I hope that you found this beneficial. Like I said, hopefully it's some good news that you can share with others in your organization about funds that you're able to recoup.
All right, thank you. Everyone have a great day.
Thanks for joining this webinar presented by Hainsworth Sinclair Boyd. To learn more about the firm and its services, visit hsblawfirm.com.